Good morning, everyone! The latest economic data has just landed, revealing a stark shift in American consumer behavior, but with some surprising resilience hidden beneath the surface. May retail sales dropped sharply, a clear sign that the spending spree we saw earlier this year is officially hitting the brakes. But don't let the headline numbers tell the whole story. There's more to unpack about the consumer's current state. The Commerce Department announced that overall retail sales fell by 0.9% in May, making it the steepest decline we've seen since January. This follows a revised 0.1% dip in April, indicating a clear cooling trend. The figure was worse than the 0.7% decline economists had predicted, falling to $715.4 billion. The primary culprit for this broad pullback? Auto sales. They plunged by 3.5% last month, marking the largest monthly decrease since June 2024. Remember how Americans rushed to buy cars in March, racing against President Trump's looming 25% tariffs on imported vehicles and parts? That pull-forward effect has now clearly dissipated, leading to back-to-back months of slowing activity on dealer lots. In March, spending on cars and auto parts increased by a staggering 8.9%. Scott Hoyt, senior director at Moody's Analytics, noted that sales are likely to soften further as this buying ahead completely ends and then reverses, which is inevitable. Even when you strip out volatile sectors like autos, gasoline, and building materials, what economists call the control group, sales were still down 0.3%. However, this same control group, which directly feeds into GDP calculations, actually rose by 0.4% in May, slightly better than what analysts expected. This suggests that while big-ticket purchases are declining, underlying spending on many goods remains somewhat solid. Perhaps with less money going into gas and cars, consumers are redirecting those funds elsewhere. Still, many categories saw significant declines beyond just vehicles. Sales at home and garden centers dropped 2.7%. Electronics and appliance stores, along with grocery stores, saw declines of 0.6% and 0.7% respectively. Grocery sales declined for the third consecutive month, dropping by 0.8% in May. Even discretionary spending at restaurants and bars fell 0.9% in May, reversing a solid gain from April. This marked the first decline in spending at bars and restaurants since February, and the sharpest since February 2023. Gas stations also experienced a significant drop in sales, down 2%. However, there were indeed bright spots. Online retailers continued their strong run, with a 0.9 sales increase, part of an 8.3 jump for non-store retailers year over year. Clothing stores saw sales rise 0.8%, while furniture stores experienced a notable 1.2% increase. Even sporting goods stores saw a positive bump, with sales up 1.3%. This rise in online sales, coinciding with Memorial Day promotions, suggests consumers may have been taking advantage of sales and discounts. For businesses, the impact of tariffs is becoming painfully real. Paul Casaro, CEO of Picnic Time Inc., a company selling picnic accessories like baskets, coolers, and folding chairs, reported that orders from retailers are down as much as 40% this summer compared to a year ago. His company sells to a variety of stores, including Target and Williams-Sonoma. Casaro noted that some stores have been cautious and even canceled orders because the new prices were uncertain due to tariffs. Roughly 80% of Picnic Time's goods are made in China. The company, based in Moorpark, California, was forced to raise prices by an average of 11 to 14% for this season. For example, a folding outdoor chair now costs $137 this month, up from $120 in late 2024. His company's sales are still down this year, despite some shoppers accelerating purchases out of concern that prices would rise. Casaro emphasized that consumers are very price-sensitive. The company has also implemented a hiring freeze due to tariff costs, having already paid $1 million in tariffs this year, a significant jump from a third of that amount a year ago. Other major brands like Walmart, Lululemon, J.M. Smucker Co., and Deckers Outdoors, which is behind shoe labels such as Hoka and Uggs, have also indicated plans to or have already raised prices in response to tariffs. Stephen Fashing, CFO of Deckers Outdoor, stated they expect to absorb a portion of the tariff impact, but also believe there's potential for demand erosion associated with the combination of price increases and general softness in the consumer spending environment. The real estate firm JLL's president of retail advisory services Services, Naveen Joggi, reported hearing from malls that sales are slowing and retailers are pushing up back-to-school promotions to this month from July, fearing consumers won't spend in later months when prices are higher. We're also seeing shifts in household budgeting. Liza Gresco, a mother of 3 from Doylestown, Pennsylvania, described how she's buying groceries in bulk, switching to generic brands, and even shopping at thrift stores for children's clothes as prices for basics like toothpaste and shampoo begin to rise. She emphasized that even with store sales and discounts, the rising costs make it unsustainable to continually purchase new clothing. This cautious sentiment is widespread among shoppers. PYMTS intelligence data indicates 37% of consumers are buying less overall, 25% are buying in smaller quantities, and 32% have cut back or postponed dining out or traveling. Despite these slowdowns, the broader economic picture shows inflation has cooled and unemployment remains low, which could potentially support spending in the months ahead. Consumer prices rose just 2.4% in May compared with a year ago, the government said last week. Economists like Ellen Zentner from Morgan Stanley observe that consumers are downshifting, but they haven't yet slammed the brakes. However, the National Retail Federation's chief economist, Jack Kleinhans, cautions that while core retail sales are growing, the inflation associated with tariffs is still expected to be felt later this year. He warns that these costs are likely to weigh heavily on consumer budgets. Stephen Stanley, chief U.S. economist at Santander, anticipates price hikes associated with tariffs are coming, most likely in June and July, which will lead consumers to pare back temporarily. Michael Pierce, deputy chief economist at Oxford Economics, expects a more marked slowdown to take hold in the second half of the year as tariffs begin to weigh on real disposable incomes. The Federal Reserve is meeting as we speak, and while they're widely expected to keep interest rates steady, they'll be closely monitoring how tariffs and rising geopolitical tensions, such as the conflict between Israel and Iran, might impact prices and consumer confidence. The market is increasingly wary, with the Dow, S&P 500, and NASDAQ all seeing pre-market declines. Some analysts, like Gregory Dacco of Ernst & Young, suggest we could see the onset of a more pronounced slowdown in the economy, driven not necessarily by tariffs themselves, but by a surge in anxiety. Lydia Bausor, senior economist at EY Parthenon, predicts a sharp deceleration in spending through the remainder of the year before recovering in 2026. Further compounding concerns, household wealth has been eroded amid tariff-induced stock market volatility, and student loan repayments have resumed for millions of Americans, potentially removing a major consumer economic force from stores. The World Bank also recently downgraded its global economic forecast, citing Trump's tariffs, projecting U.S. economic growth to be half as fast in 2025 as it was in 2024. While the current data might seem mixed, it clearly signals a more cautious consumer navigating a landscape of tariff uncertainty and global instability. What happens next will depend on how quickly these tariffs manifest in higher prices and how resilient American households truly prove to be amidst a slowing labor market and dwindling excess savings. Thank you for joining me for this update.